It's not how much I think this property is going to be worth in 5 years or 10 years. In the stock market, that's what a lot of people are looking for. They're looking for companies that are going to be worth a whole lot more. That way they can sell their stock for a big profit. Here, I'm not really interested in that. The most important thing here is, what's up everybody, I'm Jaspreet Singh, and everybody's trying to figure out how they can get their first $100,000. So what I want to do today is talk about things that you can do to help you get to that six-figure mark, even if you don't have a lot of money. So let's jump right in. I think more and more people are finally starting to realize that investing is the real secret to building wealth. But if you have $1,000 to invest, where should you put that $1,000 this year to turn that $1,000 into something a whole lot bigger? To really answer that question the right way, you got to ask yourself, is this $1,000 the only $1,000 that you have? Or do you have $1,000 today and then you can add more money to your investments over time? I want to start by talking about here, assuming you only have $1,000 to invest and that's it. So you're going to take this $1,000 and put it somewhere and then you're going to let this money grow, assuming you only have $1,000. Then I'm going to get into what if you have $1,000 right now and then you can keep investing more money every month or every year. If you only have $1,000 to invest and this is money that you've been saving up, getting ready to invest, and you want to put this money somewhere, that way you can grow this $1,000 into something bigger, then the stock market or your traditional investments are probably not the right place to go, because if you put $1,000 into the stock market and let's assume you can get a great return, you get a 50% return after 1 year, that means after a whole year of investing your money, you're only going to make $500. Now, a 50% return is an amazing return, but $500 is not really going to change your life. So your goal should be to use this $1,000 to create more income. That way you have more money to invest in things like the stock market, and I'll show you why. If this is your first time investing money, then chances are you are probably going to be a little bit scared or a little bit hesitant because you don't want to lose this hard-earned $1,000. And so you might be looking for something that's low risk. And for a lot of people, that might mean investing your money in the bank, in your savings account. The issue with that is right now, at the time I'm recording this video, the average savings account in America is paying out something like 0.05% a year. That means if you put your $1,000 in the bank for 5 years, so you didn't get to use this money for 5 years, you let it sit there and compound in your bank at 0.05% a year for 5 years, then after 5 years, your $1,000 would grow to a whole $1,002. You made $2 after 5 years. It's not worth it. Your money, your investment is safe in the bank, but it's not making you any money. So you are never going to build wealth. You are never going to get rich at this rate. The next level higher after savings account for the majority of people is then a bank's CD. A CD is a certificate of deposit, and this is where you put your money in a bank account, but you're not allowed to pull the money out. So if you put your money in a 5-year CD, your money is locked up with the bank for 5 years and you cannot access your money for those 5 years. And if you do try to access that money, then the bank is going to charge you a huge fee. The reason I talk about CDs is because back when I was in high school, my math teacher told me multiple times that the best place where you can invest your money is a CD, because your money is safe and you are going to get a guaranteed return on your money. So you tie your money up in the bank, you get a guaranteed return. It's better than a savings account, but the only problem is you don't really make that much money here either. Right now, the average CD in America is still paying less than 0.5% a year. So if you invest $1,000 in a CD for 5 whole years, now your $1,000 after 5 years and after your money being tied up for all 5 years is going to grow to a whole $1,018. You made more money than here, but you still only made $18 after 5 years with your whole $1,000 investment. Now, if we move away from the bank products and you invest this $1,000 into the stock market and you can get an average 7% return for all 5 years, then after 5 years, your $1,000 investment will grow to $1,400. That's a lot better than here, but you're still making less than $100 a year. So this is not life-changing money. That's why if you only have $1,000 to invest, I want you to be a little bit more active with your money. That way you can create more income so that you can invest more money here. There's 2 ways that I want you to invest this $1,000 right now. That way you can start attracting more money so you have more money to invest. The first way is by investing in your mind, by learning a skill. You need to right now invest in your knowledge. That way you have some value that you can give to the world, because if you have more value that you can provide, the world will pay you more money. This can mean buying books, buying courses, or attending seminars. Right now, you just got to be absorbing knowledge. That way you have more value that you can provide to the world. I mean, you can learn things like digital marketing, you can learn affiliate marketing, you can learn coding, you can learn design. You just gotta learn some value that other people and other companies need. That way you can start making more money. The second thing that I want you to do is now invest in actually creating that income. The great thing about being alive right now is it is more accessible than ever to create a new income stream on the internet. So anybody can do this. The downfall is you got to be the one to kind of go out of your comfort zone and find a way to create this new income. I started Minority Mindset with less than $1,000. I don't even think I spent $500 when I started Minority Mindset. I started the company by making YouTube videos with my cell phone in front of a white wall. That was it. The only thing I spent money on was like a $25 tripod on Amazon and a couple $20 or $30 lights. That was it. I don't have any fancy editing software, no fancy microphones, no fancy cameras, no fancy equipment. I just started talking in front of my phone. I invested a lot of time on my end. I spent a lot of time learning how to make videos. I spent a lot of time making videos, and I spent a lot of time trying to learn how to not be awkward on camera. Although I'm pretty sure I'm still awkward on camera. But we were able to grow from that small investment of less than $1,000 to now a full financial media company where we have a daily financial newsletter. We have like a dozen writers writing for our blog every single day, and we have an awesome office and a really cool downtown. If you only have $1,000 to invest and that's it, right now you gotta invest in your knowledge first. So books, classes, seminars, and once you do that, then you gotta invest in taking action. Find something that you want to do and create it and use that money to fund whatever it is you want to do. Second, if you have $1,000 right now to start investing and then you can add more money to your investments every single month, now your options are a little bit different. At this point, you have a steady stream of income. Maybe you're working a job and you saved up $1,000 and every month you want to add more money to your investments. Or maybe you're running your own business and you saved up $1,000 that you can invest somewhere else, and every month you can add more money to your investments. Whatever it is, you have the steady stream of income where you have $1,000 to invest right now, and you can keep adding more money to your investments. Now, obviously, the things that I just talked about always apply. You should always be investing in your education, and if you want to create more income, invest in yourself. But I want to talk more about passive investments, where now you take this $1,000 and this money you invest every single month and you put it somewhere that way now your money's out working hard to make your money while you continue to create this income stream. So you're making money from your job, and now every month you're investing money here. That way your money can keep generating you more money while you're working hard to make more money too. The first way that you can invest your money is through the stock market. But the way I want you to invest your money in the stock market is a little bit different than what most people think about when they say the stock market. The stock market is a place where you can go and invest in some of your favorite companies. So you can go to the stock market and invest in Chipotle and Amazon and Lululemon and Apple. And if you do that, you become one of the owners of Chipotle or Amazon or Lululemon or Apple. Now, when these companies make money, so do you, because now your stock price will go up or they'll pay you with dividends. But if you're investing $1,000, that's not the way that I want you to invest your money in the stock market. What I want you to do is invest your money in index funds. Here's the thing. Let's say you invest all your money in Chipotle, and then some time goes by and then Chipotle starts releasing some really bad guac and people start getting really sick from this guac. And then Chipotle has to declare bankruptcy because of all the lawsuits they have to go through because of the bad guac they serve their customers. If that happens and Chipotle goes bankrupt, not because of what you did, but because of their executives who drove the company into the ground, now your investment is worthless, even though you invested all your money into Chipotle thinking that they would make a great product. When you invest in individual companies like Chipotle, then you have the opportunity to make a lot of money because Chipotle can come out with a new type of guacamole and people could love it and they could double their revenue and their stock price could double, which would make you a whole lot of money. But the flip side is it also comes with more risk, because if Chipotle doesn't do good or if they go bankrupt, then your money just goes away. If you're not interested in spending a decent chunk of time studying companies, learning to invest, and reading their earnings statements, then you probably don't want to be investing in individual companies because, well, there's a whole lot more involved than just finding a hot stock to invest in. That's where index funds come in. Because with index funds, now you don't have to find the perfect company to invest in. You can invest in a group of companies. Like you can invest in the general stock market, or you can invest in tech stocks, or you can invest in dividend paying stocks that where you're getting cash flow. So now you're not trying to find the best company to invest in. You just got to find what you want, whether it's dividends or real estate or technology or the general stock market, and then you can invest in that general sector. The way you invest in these funds is the same way you invest in stocks. You just go into your stock brokerage, enter whatever fund you want to buy, and then you can buy it. But I do got to let you know that you are not guaranteed to make money when you invest. You might even lose money. Even if you invest in an index fund, you can still lose money, which is why you always want to do your own due diligence and you never want to blindly listen to a random guy on YouTube. Let me give you a few examples. Again, these are just examples, not things that you need to invest in, so make sure you do your own due diligence. If you wanted to invest in the general stock market, you could invest in funds like VOO or SPY. These index funds give you exposure to the S&P 500, which essentially means if you invest in VOO or SPY, you are getting exposure to the 500 biggest companies in the United States. Now, usually, if the economy grows, these 500 companies will grow, which means these funds will grow along with the stock market. If the economy is shrinking, these funds will go down too. If you're a big fan of technology and you want to get exposure to the technology sector, then you can look at funds like VGT and QQQ. These funds will give you exposure to tech companies like Apple and Microsoft and PayPal. So if you want to get involved in tech, this is a good way to go. Now, both of these funds are going to give you exposure to different companies. So what you want to do is actually research these funds. Just go to Google and search these funds and you will get a whole bunch of articles explaining which companies these funds invest in. So make sure you do your own research. And then for those of you who like passive income, you can look at investing in dividend ETFs like VYM and SDY. This Y is all messed up. These funds are investing in companies that pay out big dividends, and so when you invest in these funds, you're investing in a fund that invests in a whole bunch of dividend-paying companies, and so now these dividend-paying companies are paying into this fund, which pays you. Now, the best way to actually invest your money is to create an automatic system where anytime you get paid, a portion of your paycheck, let's say 15% of your paycheck, will go directly into the funds that you want to invest in. That way now, anytime you get paid, your money will automatically go into the funds that you want to own. That way you don't actually spend your investment money. If you do want to learn more about how to automate the system and how to find a brokerage that can automatically invest your money every month or every paycheck, our team put together an amazing guide that goes through how to do this step by step. So if you want to learn more about how to do that, I will link it for you in the description below. The second way to invest your money, if you have $1,000 right now and more money coming, is through real estate, but not the traditional way of investing in real estate. Real estate investing is when you buy a property, let's say a house, and then you lease this house out to a person, and then this person lives in your house and they're going to pay you rent every single month. The problem with that is you cannot buy a house for $1,000, or at least not a very good house. But thanks to the internet, you don't actually have to buy physical real estate anymore to get exposure to real estate investments because you can use a crowdfunding platform. When you invest in crowdfunded real estate, now you can invest a small amount of money, like $1,000, and now you will get exposure to a whole portfolio of real estate investments. So now when these real estate investments make money through rent, or when the property values of these investments go up, you'll make money too. The good thing about most of these crowdfunding platforms is they pay you with passive income, because now when these properties get rental income, you get your share of that through your passive income dividends. The downfall is your money is not as liquid. You can't just sell your investment as easily, because when you invest in real estate, now you own a physical property, and selling a property is not as easy as selling a stock, where you can buy and sell a stock in just a matter of seconds. With real estate, your money is kind of tied up for a number of years. So if you like the idea of investing in physical real estate and you don't have the capital to buy actual properties, and you don't mind having your money tied up for a number of years, then using one of these crowdfunding platforms is a good way to go. Again, if you do want to learn more about how to actually do this and implement this real estate strategy, our team put together a guide on how to do it, and you can read the article on our website, and I'll link it for you in the description below. You can also get indirect exposure to real estate through REITs on the stock market. REIT stands for Real Estate Investment Trust, and when you invest in a REIT, now you're not investing in actual real estate, you're investing in a company that invests in real estate. So it's kind of like indirect real estate investing, because you're not getting exposure directly to the property, you're investing into the company that owns the property. The great thing about REITs is REITs tend to pay out higher dividends, so you get your passive income, because REITs are required to pay out 90% of their profits to their shareholders, you investors, through dividends. If you are interested in going into REITs, then you can look at investing in REIT ETFs, kind of like what we talked about before. And a couple examples of REIT ETFs are VNQ and USRT. If you're not too interested in stocks or real estate, then the third thing you can look at investing your $1,000 into this year is paying down your debt early. If you have a loan and you're paying 4% a year on this loan, whether it's your car loan or your mortgage or your student loan, well, if you pay that loan off 1 year early, that's a guaranteed 4% return you just got on your money, because that's 4% that you do not have to pay to your bank. So if you want to invest your money and get a return on your money, but you don't want to put your money in stocks or real estate because you're not a big fan of risk, and you don't want your money just sitting in your bank or a CD somewhere that's not earning you a return, then you can use your extra cash to pay down your debt early, because that's going to give you a guaranteed return. The faster you pay down your debt, the less interest you have to pay, and the faster you can be financially free, because now anytime you make money, you get to keep more of it. Cryptocurrency started off as this whole idea of being a decentralized, worldwide digital currency. What that means is now, instead of going from America to India, where you take dollars to rupees, you got to convert them and worry about how to transact this money and transfer this money, now cryptocurrency has transformed into something a whole lot more. Obviously, you still have the currency portion, because one Bitcoin in the United States is the same as one Bitcoin in Canada, is the same as one Bitcoin in Mexico, is the same as one Bitcoin in India, is the same as one Bitcoin in Japan. But there's more to cryptocurrency now than just being able to make transactions. The blockchain, or the technology behind cryptocurrency, allows you to do so much more. It allows you to create DeFi, or decentralized finance. So now you can create a whole new industry of finance on the blockchain. You can do transactions on the blockchain. You can store data on the blockchain. So the blockchain has opened up a whole new world of the internet, because it's a brand new technology that really hasn't been cultivated yet. Now, if you're one of those people who think, I don't know if I should trust cryptocurrency or not, well, I have a couple videos that you can watch first. One of them is with a guy named Peter Schiff. It's an interview that I did with him. He's an economist, and he says that Bitcoin is going to zero. He says that cryptocurrency is going to nothing, and he says that it's all crap. So you should watch my interview with him. That way you get his perspective. And then I did another interview with a guy named Michael Saylor. He's the CEO of a company called MicroStrategy. It's the publicly traded company. And his company, during the 2020 pandemic, bought something around $3 billion worth of Bitcoin. So he thinks Bitcoin is going to pretty much infinity. So you have two completely different viewpoints. I recommend you watch both of those interviews. That way you can get an idea of what you think is right. And that way you can make a better decision for yourself, because I always say that you want to hear from opposing viewpoints. That way you can make the best decision for yourself. But what I want to do in this video is actually talk about a couple of different cryptocurrencies. If you're thinking about now actually buying cryptocurrency, knowing what you might want to consider buying. Now, you might notice that on this channel, I don't do stock picks. There's a reason for that. The reason being is because what's a good stock pick for me might not be a good stock pick for you, because our goals will be different and our timelines might be different. When I buy versus when you buy, and how long you plan on holding. I'm a long-term investor. If you plan on holding for 2 years and I plan on holding for 20 years, what happens in 6 months or 2 years is going to be very different than what happens over 20 years. That's why I don't like the whole idea of giving stock picks, because a stock pick can be wrong until it's right, and it can be wrong for a while before it's right. So there's a lot more to picking stocks or even cryptocurrencies than just picking the right stock, or picking the hot stock, or picking the hot cryptocurrency. But in this video, I want to do something a little bit different. I do want to talk about a couple of different cryptocurrencies that you might want to consider buying, especially if you're starting off, because these two cryptocurrencies can give you exposure to the broader cryptocurrency market, and they'll give you different exposures to cryptocurrency on the blockchain side and the property side. There are thousands and thousands of different cryptocurrencies out there. Some of them are complete crap. Some of them are your meme coins, like the Dogecoin and Fluffy coin. And then you have some that have more technology and more use behind them. Now, obviously, some of these cryptocurrencies are way more speculative than others, where people are just throwing their money into these meme coins or these speculative coins. That way they can hopefully double their money very quickly. They're hoping to see big gains, because it's kind of like gambling. And so you have a lot of coins where it's essentially gambling. People have no idea what the coin is. They're just hoping that it's going to get some traction and that they bought it early enough. That way they can see a massive run up and sell their coin for 10x what they bought it for. You do see that happen, and sometimes you can be right and you can make a lot of money. Other times you can be wrong and you lose all your money. So if you're just starting off, you don't want to be in the business of gambling. You don't want to be in the business of speculating. I'm not a speculator, but there are places that if you were just starting off that you might want to consider starting in. That way you can get some broader exposure to the cryptocurrency market. Now, obviously, investing has risks. You are never guaranteed to make money when you invest. You might even lose money. So always do your own due diligence and never blindly listen to a random guy on YouTube. And the thing that you have to understand about cryptocurrency more specifically is a cryptocurrency is way more volatile than pretty much any other asset class, because one, it is a newer asset class. While the size and the number of dollars in cryptocurrency is growing, is still pretty far away from the amount of dollars in the stock market and the amount of dollars in the real estate market. And so you have to understand that because it's smaller, you can see a whole lot more volatility. And so you have your other fair share of risks when you invest your money in cryptocurrency. Not to mention the fact that you also have a lot of speculation in cryptocurrency. And you also have a lot of debt in cryptocurrency. People refinancing their homes or maxing out their credit cards and putting money into cryptocurrency. And so because of these things, you can see a lot of wild swings in cryptocurrency. And it wouldn't be really out of the ordinary if we saw another 2001 style dot-com crash in the cryptocurrency market. So a couple things you got to be aware of. Cryptocurrency is speculative. You can lose money in cryptocurrency and you could see a massive crash in cryptocurrency. Now that being said, even though we saw a massive crash in the dot-com market in 2001, that doesn't mean that the internet went away. The internet is thriving today. And just like that, just like how we saw a 2008 real estate meltdown, that doesn't mean that real estate doesn't exist today. Real estate is booming today. And so what you have to understand is you are going to see a lot of volatility in the cryptocurrency market. And so that's one of the prices that you have to pay for trying to get into cryptocurrency as one of the earlier adopters. Now, obviously, an early adopter will be buying cryptocurrency back in 2015 and 2016. But relative to maybe where cryptocurrency will be in a decade, you're still relatively early. The first cryptocurrency that you want to consider owning is Bitcoin. Now, I do also got to say that both of the cryptocurrencies that I'm going to be talking about today are both cryptocurrencies that I own. But the reason that you want to consider owning Bitcoin is because this is kind of like the big daddy when it comes to cryptocurrency. Originally, when people thought about Bitcoin, they thought about using Bitcoin as a currency, just as a currency, meaning a means of exchange. So if I want to go shopping, I can pay for my order with Bitcoin. But nowadays, people look at Bitcoin very differently than they used to because now people look at Bitcoin like property. So Bitcoin is unique where there is a maximum of 21 million Bitcoins that can be mined. So that's it. There are 21 million potential Bitcoins. After you hit 21 million Bitcoins, that's it. Everyone will be fighting to own the same number of Bitcoins. And so this is why people now consider Bitcoin not necessarily as a currency, but more as property, because if you get this world where more and more people want to own Bitcoin and there's a limited supply of Bitcoin, it'll be more beneficial for you to actually own the Bitcoin rather than just spending it. Because if you believe that Bitcoin is going to go up in value, why would you want to spend your Bitcoin to go out and buy some candy when you can just hold on to your Bitcoin and tomorrow you might be able to buy 2 candy bars, right? So Bitcoin is more of as property than it is a currency, but the value that Bitcoin has can be explained a couple of different ways. So if you want to create more Bitcoin, it has to be mined. And it has to be mined through something called proof of work. So I'll label that POW. Proof of work means that if you want to create more Bitcoin, that you have to have this computer and it has to do these math questions, these math answers, and they get more complex as you mine more and more Bitcoin. And if your computer gets the question right, well, then you get to produce some Bitcoin. Now, the use and the energy here is the electricity and the energy power of the computer that has to be used to mine the Bitcoin. It can be very expensive if you want to be a miner because you need all the electrical power, you need the computing power, and so the value in Bitcoin is the energy that it takes, the proof of work that it takes to actually produce and mine that Bitcoin. And now that we've mined so much Bitcoin, it's taking more and more energy and more power in order to mine more Bitcoin. So that's how it takes energy and work to mine the Bitcoin, which you can kind of relate to gold. It takes time, effort, and labor to mine gold. Now, that time, effort, and labor is very easy to see when we talk about gold because somebody has a tool, they're going into the caves, they're going into the ground, and they're hammering at the cave, that way they can get physical gold. In the digital world, it's not as easy to understand because it's a computer that's using its computing power and electricity power to mine Bitcoin. But that's how it's working in the digital world. Now, it's up to you whether you believe that this has any real power or it doesn't, just like how it's up to you whether you want to believe that gold has real value or it doesn't. I mean, obviously gold has value because people use gold in different industries, but it's up to you if you believe that gold is valuable or not. Just like that, it's up to you if you believe that Bitcoin has value or not. Now, if you think that the world is going to be moving more digital and that people are going to want to own property digitally, then you would be of the belief that Bitcoin is going to be more valuable in the future because more and more people are going to want to own this type of digital property. So if you can get your hands on some of this 21 million Bitcoin, it's going to become more and more scarce because Bitcoin is a deflationary asset with that type of mindset. So compare that to our dollars. Our dollars are inflationary, meaning our dollars can be printed out of thin air, and you have more and more dollars being created every single year, and there's nothing that you can do to stop it. So you might have $1 million in your hands right now, but relative to the amount of dollars out there, your $1 million is going to become less and less valuable because the Federal Reserve Bank and the government can keep working to print more dollars. As more and more dollars get printed, the value of your $1 million becomes less and less and less. Compare that to Bitcoin, where if you own one Bitcoin, well, you own one Bitcoin. The supply is not changing. You can't just create more than the 21 million Bitcoins. However, the demand will change. Because if more and more people go out and they want to own Bitcoin, then now the value of your Bitcoin becomes more because you cannot increase the supply. The argument people have is, oh, well, you could just create a different cryptocurrency. There's thousands of different cryptocurrencies out there. Sure, but none of them have come close to the power and the technology that Bitcoin has. So when it comes to actual Bitcoin, there's only one Bitcoin. And then if you own one of the Bitcoins, you own one of the 21 million units of Bitcoin. And now if the demand continues to rise, if more people believe in Bitcoin, they believe in the power of Bitcoin, they believe in the power of digital property, well, that will make the value of your Bitcoin higher. Now, I want to remind you of probably one of the most powerful and influential statements that Michael Saylor made in the interview that I had with him, which was, if you do not plan or have the willingness to hold on to Bitcoin for 10 years, you probably shouldn't own Bitcoin for 10 minutes. Because the issue is you have a lot of people that are just trying to look at Bitcoin and these cryptocurrencies as a way to get rich quick. They're looking at it as gambling. They're speculating. They're just hoping that, hey, I can buy this and flip it in 2 weeks or in 2 hours. But if that's what you're looking for, then you have to understand that there's a lot of risks that you carry with that, because one, you're speculating, two, you're gambling, and third, you're going to see a lot of volatility. You can see huge spikes and crashes with Bitcoin because you're going to see a lot of pain, a lot of different regulations that are going to happen with different countries and different adoptions of Bitcoin in different countries. And so all these things are going to affect what's going to happen with Bitcoin over the next decade. But if you believe in the value of digital property, if you believe in the value of the internet and what blockchain can do, then this is something that you may want to consider owning for the long term. So when it comes to understanding the value of Bitcoin, the first one is obviously using it as a currency, like we talked about, although the actual use of Bitcoin as a currency isn't as attractive anymore because people don't want to transact with Bitcoin, especially because it's so volatile and also because they want to own Bitcoin for a long time. If people want to actually use cryptocurrency as a currency, now what people are leaning towards are stable coins. Stable coins are coins that don't change, they don't fluctuate. That's why they're called stable coins. Many times $1 is one stable coin. So if people want to make transactions with cryptocurrency, they'll use things like stable coins. They don't want to use Bitcoin, but you still have that use of Bitcoin as using it as a currency. And then you also have the power of looking at Bitcoin like property, digital property. Now, obviously, you're seeing people buy digital land onto these things like the metaverse and all that, but that's a topic for a separate video. The second cryptocurrency that you may want to consider buying is Ethereum, and I'll leave that Ethereum. Make sure I spell that right. Ethereum works very differently than Bitcoin because it has a very different technology behind Ethereum than Bitcoin, and Ethereum's blockchain, the blockchain behind Ethereum, has so many more uses that Bitcoin doesn't have. The first thing that I want to mention regarding Ethereum versus Bitcoin is that Ethereum has really no limit to how much Ethereum can be created. Now, there are annual limits to how much Ethereum can be created, but every year the supply of Ethereum keeps going up. That's very different than Bitcoin, which is why people don't look at Ethereum as the same type of investment than Bitcoin, because people look at Bitcoin like a property. I want to own one of this limited supply coins or a piece of a limited supply coin when it comes to Bitcoin. But with Ethereum, you're really investing in the technology which allows Ethereum to do so many other things. And the way that you produce Ethereum is also very different than Bitcoin. Bitcoin is through the proof of work model, which is where you have to do the actual mining of Bitcoin. You have a computer, it answers math problems. If you do it right, using electricity and the computer power, you get rewarded with Bitcoin. With Ethereum, it used to be like that. It used to be a proof of work model, but then you had Ethereum get revamped and remodeled, and now Ethereum follows something called the proof of stake method. So, I don't know, POS looks like something else, but proof of stake means that now, instead of you actually using this computing power to produce more Ethereum, if you own Ethereum, you can stake your Ethereum, meaning you lock up your Ethereum, and this Ethereum is going to just make sure that the transactions that are happening with Ethereum is good. You don't really have to do anything, but you lock up your Ethereum for a certain period of time, and if you do that, you get rewarded with interest, more Ethereum. So if you lock up your Ethereum, you can help produce more Ethereum. Now, at first glance, you might not see a lot of difference yet between Bitcoin and Ethereum. Sure, maybe the way that you earn more Ethereum and Bitcoin is a little bit different, and sure, maybe you can have some more Ethereum than Bitcoin, but they're still just two random cryptocurrencies on the internet. And what is the difference behind them? Well, if you look at the technology and what they can do, that's where you will really start to see the differences, because Ethereum and Bitcoin will do two completely separate things. So obviously Ethereum, you can use it as a currency, because if you wanted to pay somebody, if you didn't want to use a stable coin, you wanted to pay them, you could potentially pay them with Ethereum. I mean, you could just say, hey, you want me to buy your lights or your whiteboard, I'll give you some Ethereum for that. And if they're willing to accept it, then sure, you can use Ethereum. Now, that isn't the goal behind Ethereum, but that is one thing that you can do. But this is where now, if you look at the blockchain behind Ethereum, you can do a whole lot more. The first thing that you can do with the blockchain is you can do something called smart contracts. Smart contracts are a very unique thing to cryptocurrency, and this is not something that we've really seen anywhere else. A smart contract allows you to automatically create a contract and execute on the contract whether or not the payment or the thing was supposed to happen. So this is a financial channel. So let me kind of break that down. Let's assume that you are a real estate investor and you create a smart contract with your tenant. The smart contract says that your tenant has to pay you $1,000 a month every single month, and if they do not pay you this $1,000 on the first of the month, then automatically your tenant will be locked out of the home. This is a smart contract because the contract says that the tenant must pay $1,000 a month and they can have this money automatically withdrawn into your account. And if for whatever reason the $1,000 does not leave the tenant's account, does not go into the owner's account, well then the keys are going to be automatically changed, the house is going to be locked, and now the tenant will not be able to access the property because it did not fulfill their end of the smart contract. So smart contracts don't have emotions. You enter in what is supposed to be done in the contract, who does what, and if somebody does not fulfill their end of the obligation, well then the contract does whatever the punishment is. It might be locking the doors, or it might be withholding something. So the contract, you can fill everything that you want in there. What will happen if this does not happen? It is a robust contract which has the laws of the contract written there, and if somebody doesn't do what the contract says, then you will get whatever the contract says it does. So it is literally like a machine that just executes whatever you put in it. Now, this is where it's very important that if you use these type of smart contracts, you have to be very specific as to what will happen if somebody doesn't do something and kind of all the different variables that you have, because a smart contract doesn't have emotion. All it does is it looks at the rules and then it executes whatever the rules are. The second value that Ethereum has is it has the technology, the power to fuel a DEX, a decentralized exchange. So let's assume that you have Bitcoin and you want to convert it to Ethereum, or you have Ethereum, you want to convert it to Bitcoin. Well, you can go onto a platform like BlockFi or Coinbase or Gemini or whatever, and then you can convert one cryptocurrency to the other. Now, all of these are centralized exchanges. Like Coinbase is a centralized exchange because it's run by Coinbase, and BlockFi is run by BlockFi, and Gemini is run by Gemini. But then you have some decentralized exchanges. This would be something like Uniswap. Uniswap is a decentralized exchange that's built on top of the Ethereum blockchain. So Uniswap is this platform that takes the technology behind Ethereum and it builds an exchange where you can convert one cryptocurrency to the other. Now, the advantage of something like Uniswap, which is a decentralized exchange, is it's completely anonymous because it's not controlled by one entity. It's controlled by the network, and it's completely anonymous. So there's no reporting that goes on with Uniswap. So you go into Uniswap, which is built on top of this anonymous Ethereum blockchain. You can convert one cryptocurrency for the other, and it's completely decentralized because it's not controlled by one entity, it's not controlled by one government, it's not controlled by one agency. This whole concept of being decentralized can be hard to wrap your head around because it took me a while to understand what the whole idea of decentralization meant, which brings me to DeFi, which will help explain what that means. So if you're a little confused, don't worry, I'm gonna explain it right here. DeFi is decentralized finance. And right now, the way the financial industry works is everything is centralized. If you want to go and get life insurance or any sort of insurance, you have to go through an insurance broker. If you want to go and borrow money to buy a home, you have to go to a bank, another centralized entity. So what decentralized finance says is you can do all of this without having to go through that third-party intermediary. Actually, these decentralized exchanges are a part of DeFi, but I wanted to separate them that way you can understand kind of what DeFi is and separate the more traditional finance from something like a DEX, decentralized exchange. But now what DeFi allows you to do is instead of going to an insurance company to get your insurance, you can go directly to somebody who will give you this insurance, and they will do that through a smart contract. So let's say you have a business that you want to insure, and I'm willing to give you insurance on that business. Now, what we can do is create a smart contract that if you get sued in your business, then I will automatically have to pay you a certain amount of money depending on what the lawsuit is. So we create this smart contract which says that you are going to pay money into this insurance pool, and this money comes to me every single month. And then if a certain lawsuit happens, then I will now release certain amounts of money to you. So you're not going through an insurance agency or an insurance broker, you're working directly with the person who's funding the insurance. Likewise, in the lending industry, instead of you going to a bank, you can work directly with somebody who wants to lend you money. You want to go out and buy a home. Great. Well, now you can work directly with somebody who's willing to lend you the money. Maybe I have some extra cash and I'm willing to lend you this money. That way you can go out and buy a home. Well, through the help of a smart contract, through this Ethereum blockchain, you can do that. You and I can create a smart contract that says that you are going to borrow $300,000 to buy a home, and in exchange for you borrowing this $300,000, you're going to pay me interest. You're going to pay me 5% a year in interest, and this money has to be deposited into my account. And if you miss 1 month, then you're going to get a penalty. If you miss 2 months, you're going to get a different penalty. But if you miss 6 months in a row, well, then now the keys to your home are going to be forfeited, and your house is going to be locked, and then it goes into foreclosure. A smart contract can do all of this, so it saves a whole bunch of fees, because now you might be able to get a better rate through me than by going through the banking industry. You don't have to deal with banks, and the whole process is so much easier, it's cheaper, and on the bank's end, or in this case on my end, the foreclosure process is so much simpler because it's all under a smart contract. And then after all of that, you have the NFTs. So you've probably heard people talking about NFTs, the digital art, where NFTs allow you to digitize and tokenize any sort of art on the internet. So maybe you like this video and you really like the way that I hold my marker, and you take this video, I guess in this case it would be me, I could take this video and NFT it. I can turn it into this own little thing on the internet. I can memorialize it, and now because I created this, I own the rights to this production. Well, if I wanted to, I can sell the rights to this production, and then you can be the owner. Now it'll still be on YouTube, people can still watch it, but now you are the rightful owner of that technology. So it's kind of like digital art. Somebody can own the rights to the original Mona Lisa, but you have copies of the Mona Lisa that are floating around. Now, when there's more and more copies of something floating around, now all of a sudden the Mona Lisa, the original, becomes more valuable because more people know about it. So that's the kind of the weird thing about NFTs, because people assume that, hey, I can just save a copy of a picture on my computer, so why does it matter if someone owns the actual rights to that image? Because I can just go to Google Images and see the same thing. Well, it's more for bragging rights. You own the actual thing. It's like somebody who wants to own the real Gucci product versus a replica Gucci product. You own the real thing. You can show it off. It's the social credibility. That's the power behind NFTs, and they're built on top of the Ethereum platform. Now, personally, I'm not an art person. I don't really care about owning real art, and so I don't really care about owning NFTs. But I do own Ethereum, and it's a way for me to invest into the technology behind NFTs, because now anytime you do any of these things, you're pulling some of the Ethereum off of the network, because now this Ethereum is being used to help create these NFTs, or it's being used for this DeFi, or it's being used for these smart contracts. And so when you use the Ethereum blockchain, you're using the Ethereum, you're pulling some of it off the network, which is why now you have a different type of supply of Ethereum versus Bitcoin, because the Ethereum has to be used for these technologies. This is where you can really start to see the difference between Ethereum and Bitcoin. Bitcoin is more of property. There's a limited amount of this property, the space in the world, and if you believe in the power of digital technology, if you believe that Bitcoin will continue to be this source of property that people want to own, if people will continue to believe in that, then this will become more valuable over time. So you want to own this for its property rights. It's a way for you to save your money and actually get a return on your savings because the demand for it will go up over time if you believe in Bitcoin. And so you can see a return on your savings here versus here. You're investing in the technology. You're investing in what the technology can do and what the technology can create, which is more of the future of the internet. We're going to jump back into the video in just a second. But before we do, I want to tell you very briefly about Market Insiders, our investing coaching program. If you've been thinking about investing your money into the stock market, the real estate market, or the cryptocurrency market, and you're looking for some extra guidance, this is what Market Insiders was created for. It is not a class. Market Insiders is a coaching program where every week you get access to a real estate class, a stock market class, and a cryptocurrency class, which is live, led by one of our investing coaches. Our investing coaches are not investing gurus. These are real investors who have been investing for years, they've gotten great returns, and they have the money behind them. I'm talking about hundreds of thousands, if not millions of dollars invested themselves, and they're teaching from their experiences and their failures. That way you can learn from them every single week. Now, the cool thing about Market Insiders is you get access to more than just the weekly coaching. You get the weekly investing coaching, you get access to all of our previous recordings, you get access to our investing classes, and you also get access to our private Discord community. That way you can chat with other investors. So if you're trying to get started as an investor in the stock market, the real estate market, or the cryptocurrency market, or you're trying to figure out how you can be a better investor and get better returns, then Market Insiders is for you. That way you can get that kind of handheld coaching guidance, because now it's not just a class where you're going to be left hopeless trying to figure it out for yourself. Every week you're going to get access to stock market, real estate, and cryptocurrency coaching sessions, and it's all included. Now, if you're skeptical about all this, I get it. That's why you don't have to pay a penny today. You can try out Market Insiders for free with our 10-day trial. During the 10-day trial, you'll get access to everything. You can join the coaching calls, you can watch the previous recordings, you can attend the classes, you can go through the Discord and chat in there, you can ask your questions, and then you can see if it's right for you. If during those 10 days you realize, I hate this sucks, well, then you can quit and it's not gonna cost you a penny. But if you go through it and you say, wow, this is amazing, I'm blown away by the education, well, then you can stay. And if you decide to stay, it's not gonna cost you an arm and a leg. Market Insiders cost less than the cost of going out to eat. It costs less than $30 a month. So if you wanna try it out, I'll put the link to how you can learn more and join Market Insiders with the free trial in the description below. It was very important to me that you feel comfortable investing in your financial education. That's why I wanted to make sure that you had nothing to lose and everything to gain, which is why if you wanna learn more, you can get started with a free trial. That way you don't have to commit to spending a penny until you know if it's right for you or not. So if you want to learn more and try out Market Insiders and see if it's right for you, I'll put the link to where you can get started with your free trial in the description below. If you went out and you asked the majority of people, how do most people become millionaires? They'll tell you that it's because of rich parents, or being gifted, or having a trust fund, or winning the lottery, or getting really lucky. You need to have one of these 5 things if you want to become a millionaire. But that's just not true. 88% of millionaires were self-made. These are people that created their wealth and their money themselves, that did not have everything gifted to them. Yeah, you had 12% of millionaires that had rich parents or had money given to them or had all these privileges, but the vast majority of millionaires created their wealth themselves. So if you want to understand how to become a millionaire yourself, you got to understand what these people did. Out of the people that became self-made millionaires, there are 3 general categories or ways that people became millionaires. The first is start a very successful business. Number 2 is earn a very high salary. Or third, invest a little bit of your money every time you get paid. Look, some of the most successful people in the world are people that start and build their own businesses. But the reality is, building a business is not easy, and it is not for everybody. It looks cool and it looks attractive because entrepreneurship is fun, but it is hard work, and you do not get weekends off, you do not get evenings off. Building a business is hard, and it's not for everybody. And so that is not the path to becoming a millionaire for the majority of people. And if we look at trying to earn a super high salary, like people earning $200,000, $300,000, $400,000, $600,000 a year or more, that's not really accessible for most people either, because maybe you're gonna need a special degree, maybe you gotta go out and become a doctor, or maybe you gotta go and become a CEO of a big company. But yeah, that's possible for some people, but not everybody. So I guess both of these 2 options are out for most people. But the third option, investing a little bit of money every time you get paid, is actually how most people become millionaires. It's a slow and gradual process where every time you get paid, regardless of how much money you're getting paid, you put aside a little bit of money and you keep slowly investing it, and you let this money that you're investing grow and compound. And as this money is growing and compound, you keep fueling the fire, because every time you get paid, you're just putting more and more money into this ball that's growing and building you wealth. That way you can become a millionaire in your lifetime by letting your money go out and work. I'm going to show you a few different ways that you can do that. But before I get into that, I need you to do me a quick favor and smash that thumbs up button below. Let's go over some quick numbers. Let's start by going over something that most people should be able to do. Let's assume that you can put aside $10 a day, which is right around $300 a month. If you take this $10 a day, $300 a month, and you keep investing it every single month, I'll talk about where and how to invest it in just a little bit, but let's assume that you can get a 7% annual return on your money on average. So this is a below average return, okay, something conservative. But if you keep investing this $300 a month over the next 45 years, so if you do this from 21 to 66, the $300 a month is going to grow to $1.1 million on the side. Now, if you're saying that you don't got $10 a day or $300 a month, yet you also have a $300 a month car payment or more, then you might want to rethink where and how you're spending your money. If you want to be a little bit more aggressive, and now you can put aside $20 a day or $600 a month, and you can get the same 7% return, which is below average, below the historical average, then you will be able to grow this money to $2.2 million over a lifetime on the side. And let's have some fun. What if you could be even more aggressive and you could put aside $100 a day, which is right around, let's say, $3,000 a month. If you can do that and you can maintain the same below average return, then over your lifetime, you will be able to grow your money to $11 million on the side. Now, while this all sounds good in theory, it's still theory, because now the question is, how do you actually make it happen? Because me sitting here saying that if you put $300 a month into your investments, that you would have grown it to $1.1 million is kind of like the people who say things like, if you invested 45 cents in Tesla or Bitcoin, then the 45-cent investment would have been worth $4.4 million today. So you are very not smart for not making that 44-cent investment 20 years ago. It's impossible to predict what is going to happen. So the question is, what do you do today to actually build these millions in your lifetime? How do you do this practically, and how do you make it happen? Well, the first part of making it happen is you got to work on this side of the equation. How do you get this extra cash? How do you find this extra cash every single month? And there's two things you got to do on the mental side of how do you actually get this cash. The first thing you gotta do is you gotta stop living in your feelings. We live in a culture where people live in their feelings, where when people want something, they want it now. And when you want it now, you're gonna do whatever it takes to get it. And when I say do whatever it takes, I don't mean put in the hustle and get the cash to actually be able to afford it. I mean do whatever it takes, like put it on your credit card or finance it or pay it off in installments. If the way your mind works is, I just made $1,000, so how can I spend this $1,000? I can go on this vacation, I can buy these shoes, I can go out to eat here. You will never have a chance to achieve this. It's not possible. Okay, because the first thing you got to do is you got to break out of your feelings and understand that now anytime you get paid does not mean that you got to go out and spend this money. Anytime you get paid means now you have more money to invest, because you got to put some money aside towards your investments. So the first thing you got to do is you got to stop living in your feelings, and then you got to stop spending all your money. You got to figure out what that right investment amount is for you. I recommend 15% of your income. So anytime you make $1, 15 cents should go towards your investments, but I'm just a random guy on YouTube. You got to make your own decisions. The second thing you do after you start putting some extra money aside is now you got to start growing the pot. You got to start earning more money. The thing that bugs me about traditional financial planners and traditional financial planning is that traditional financial planning focuses just on pinching pennies. But the thing that you got to understand is that at the end of the day, a penny saved is just a penny. Yes, you should not be blowing all your money. Yes, you should not spend your money as soon as you get it. Yes, you got to be smart with your money. But I also want you to work to grow the pie instead of just working to figure out how can you squeeze some extra pennies, because at the end of the day, there's a limit to how little you can spend. But there's no limit to how much you can earn. So once you understand how to spend your money, once you understand how to live below your means, once you understand how to build a system where anytime you get paid, 15% of your paycheck is automatically going to get invested, the next thing you got to do is worry about, how can I grow the pie? How can I make the pie bigger? Because if you're making $40,000 a year and you're investing 15%, that's good. But if you're making $400,000 a year and now you're investing 15%, that's even better. Again, going back to the beginning of this video, most people are not going to be able to start their own business, and most people are not going to earn a doctor's salary. But what you can do is you can supplement your income. If you're not happy with how much money you're earning, maybe you can earn a second job. Maybe you can ask for a raise. Maybe you can get a promotion. Maybe you can start a side hustle or do something to earn some extra cash. There are a lot of ways that you can supplement the income that you're getting right now. That way you have more money to grow this pot. That way you have more money going towards your investments. So the first thing you got to do if you want to get this is you got to work on this. That means you got to stop living in your feelings and you got to find a way to earn some more money. That way you have this cash to grow. Once you got this cash right here, the next thing you got to figure out is how do you make this interest, this return on your money? What do you do with this extra cash that you're investing? But let's talk about how to actually invest your money now. The whole idea of investing is you want to create this machine that is printing you money without you physically having to work. But in order to create this machine, you got to invest one of two things. Either you got to invest your time or you got to invest your money. Now, for a lot of people, either you're not going to have the time or you're not going to want to put in the time to do it. So I'm going to focus in on the passive investments, because a passive investment is where all you're doing is you're taking some of your cash and you're putting it towards creating this machine that is printing you money without you physically having to go to work, because you're going to work to get paid. Now, you're getting this paycheck and you're going to take a piece of that paycheck and you're going to put it towards buying this machine that's going to print you money. Now, it's not an actual money printing machine because you can go to jail for that, but it's a kind of a theoretical machine that's going to print you money through your investments. The whole idea behind making money is the more value that you can provide to the marketplace, the more money you're going to make. That's why doctors earn more money than cashiers, because doctors provide more value to the marketplace than cashiers do. Now, this doesn't mean that your life is not valuable or that you're not a valuable person as a cashier. This just means in the economic marketplace, a doctor provides more financial value, so they attract more money than a cashier does. So now when it comes to your investments, the whole idea here is you want to put your money in a place that is going to create value or attract value. So you want to use your money as a tool to kind of create this value thing. That way it can continue to pay you without you having to physically work to continually build value. So maybe there's other people involved or there's a team involved where this machine is now working to build value and create value for you because you have put your money towards it and your time is out doing something else. The most accessible way to do that is by putting your money in the stock market, because the stock market is a place where you can go out and invest in big companies. So Amazon, McDonald's, Facebook, these companies trade on the stock market. So when you go out and you buy shares in a company like Amazon or McDonald's, you become one of the owners of Amazon or McDonald's. Now, you don't get to tell Amazon or McDonald's how to run the company, and you don't got to go to work for Amazon or McDonald's, but when these companies make more money, so do you. Maybe your stock price will go up, because if you buy a stock for $100 a share and it goes up to $200 a share and you sell it, you just made $100. The second way you can make money is through dividends. When a company like McDonald's has a whole bunch of cash in their bank account at the end of the year, they can take some of this cash and just give it away to the shareholders, people like you, investors, through dividends. And so these dividends are literally just cash payments that you get every 3 months, every quarter, for doing nothing except owning the right company. Between 1926 and 2018, the average return for the S&P 500, which is an index in the stock market, which all it means is it's a group that represents the top 500 companies in the stock market. This S&P 500 over those years grew by an average of 10 to 11% a year on average. This doesn't mean that every single year the stock market is going to go up by 10 to 11%. That means over the long run, the stock market has grown by 10 to 11% a year for almost the last 100 years. But this also includes the fact that sometimes you're going to have stock market crashes and other times you're going to have stock market rallies. Over the long run, you've seen the stock market grow by around 10% a year for the last century. So if the stock market continues to grow at its previous rates and you can just invest your money and even get a below average return, then retiring a millionaire is no problem, because you can just throw your money into the stock market and hopefully get the same returns, and boom, there you have it, the millionaire status. Except there's a couple issues with that. The first issue is many people do not believe that the stock market is going to continue to grow at the same rate that we saw happen over the last century, because our economy is a whole lot bigger. So it's not as easy for our economy to grow as fast as it once did, which is why we might not see the same returns in the stock market over the next century. The second issue is you got to know how to actually invest your money in the market, because if you just take your money and you randomly put it in some stocks, then that doesn't mean you're going to meet the stock market return, right? Because the S&P 500 is an average of 500 companies in the stock market. market. It's not the entire stock market. During the last century, you had a lot of stocks go bankrupt and go bust. And so if you invest in a company that goes bankrupt or bust, then you lose your money and you won't get these returns even though the stock market went up because the company you invested in went down. So now, given these circumstances, how can you still get a good return in the stock market if our economy isn't growing as fast as it once used to? And how do you invest your money in the stock market without worrying about the company you invested in going bankrupt? Let's start with this. When it comes to investing, you got to first understand the correlation between risk and return, because in general, you can get a better return if you're willing to take on higher risk. And so if the general stock market sees lower returns in the future, you can still try to get higher returns, but that might mean you have to take on higher risk. Now, one of the ways that you can mitigate risk, meaning lower the risk, is by having the right education and understanding what you're doing, because if you have more knowledge, then you can kind of lower some of this risk. But you got to understand, yes, you can still get higher returns, but you got to understand how to kind of manage this risk too. So the S&P 500 index, the one that I just talked about a minute ago, that was averaging 10 to 11% returns a year, the S&P 500 is a group of the 500 largest and most established companies in the stock market. And so when a company is large and established, it's not going to be able to grow as fast. And so if you want to get better returns, then you're going to have to invest in a company that's a little bit more innovative, that's trying to grow, because now these companies have more room to grow, because when a company is already large and it controls the entire market and it doesn't have that much more room to grow, it can't grow as fast. Versus a company that's smaller and trying to innovate and grow, there's a whole lot of room for opportunity, and so they could see much better returns. So if you're trying to get better returns, then you can't be making the same investment decisions that people were making 30, 40, 50 years ago, because back then in the 70s, if you wanted to invest your money, all you had to do was invest your money in the general stock market, and you knew the United States economy was booming, and you knew the United States economy had a lot of room to grow, and so these big established companies still had so much room for opportunity and growth, which allowed these easy general stock market funds to grow and boom, which allowed people to grow their money and compound their money very quickly. You might not have that same opportunity today just because our economy is so big and these companies are so big, they don't have the same room for growth as they once did, or at least that's what people think. And so if you want to continue to get that same growth, you got to be a little bit more innovative. That means instead of just investing in your traditional large blue chip companies and these funds that give you exposure to the general stock market, maybe you got to start looking at innovative companies or value companies or growth companies, because these are smaller companies that are kind of like more of your startups that have a lot of room for growth. Now, obviously there's more risk here, because if you're investing in a startup, there's a chance that this company will fail. But if you want to continue to get those higher returns, you got to start educating yourself here. That way you can make smarter decisions. That way you can get the better returns. Does it come with more risk? Yes, because you are never guaranteed to make money when you invest. You might even lose money. So make sure you always do your own due diligence and never blindly listen to a random guy on YouTube. Now, when it comes to actually investing your money and putting your money to work, there's a couple different ways that you can invest your money in the stock market. The first way is you can find individual companies to invest in. So you can go out and invest in individual companies like McDonald's or Tesla or Facebook or whatever. But when you invest your money in these companies, you take on all the risk, because if you invest your money in McDonald's and the McDonald's executives run the company into the ground and the company goes bankrupt, now your investment account is bust. So one of the things that you can do to protect yourself, especially if you're not planning on becoming a full-time investor, or if you don't plan on spending at least a few hours a week researching your investments, then one of the things that you can do instead of investing in individual companies is just invest in ETFs. An ETF is a fund that gives you exposure to a whole bunch of companies. That way now you don't got to worry about trying to be in the stock picking game, because you can invest in a fund that gives you exposure to a whole bunch of different companies. You can buy and sell shares of an ETF the exact same way you do stocks. The only difference between an ETF and a stock is when you invest your money in a stock, you get exposure to one company, but when you invest your money into an ETF, you get exposure to a whole group of companies. So kind of like what I talked about before. If you just wanted to get general exposure to the stock market, then you can invest in an ETF like VOO or SPY. Both of these ETFs give you exposure to the S&P 500, and both of these ETFs give you exposure to the top 500 companies in the stock market. Now, again, this goes back to the concern like we just talked about. Yes, this will give you exposure to the top 500 companies, but we just don't know if the stock market and our economy is going to be able to grow at the same rate that we saw happen over the last century. Maybe it will, maybe it won't. But the thing that you have to understand about these is these typically come with less risk, because if the economy continues to grow, then chances are our big companies are going to continue to grow, which means chances are these funds are going to continue to grow. So less risk and less potential return, however, is more of a safer investment over the long term. Yes, you might see market crashes, which makes it kind of risky in the short term, but over the long term, if you believe in the United States economy, then these are generally kind of your safer investments. If you're looking for more value type investments where you can hopefully try to see bigger returns but also come with more risk, then you can look at investing in funds like ARKK, this is ARK, and QQQ. Again, these are just examples. Make sure you do your own due diligence, and as a quick disclaimer, I do have some of my own money in VOO and ARK. So these are a couple examples of ETFs that are trying to invest in more of your value companies, more of your innovative companies. That way you can hopefully see bigger returns over the long term. But again, it comes with more risk, so you got to do your own due diligence and understand how to balance it out. The key for this type of stock market investing to work is you got to understand that this is not a one-time investment that you're going to make. This is something that you got to keep consistently investing. Like I talked about that 15% rule earlier, where anytime you get paid, a portion of your paycheck is going to go directly to your investments. That way you're consistently investing a little bit of money. That way investments can compound here. Your money keeps growing here, and you keep adding fuel to the fire, because anytime you get paid, you're adding more money to the fire. You're adding more money to this machine that is working to make you more money. The second way that you can invest your money, which is actually my favorite way to invest my money, is by investing your money in real estate. The way real estate investing works is you can go out and you can buy a property like a house, and when you buy this property, so let's say this is me. I'm going to go out and I'm going to buy this property. Got to draw me a nice mustache. I go out and buy this property, and then I'm going to rent this property out to somebody else. I'm not going to live here. I'm going to let this person come here or their family. They're going to live in this property. They're going to use my house. They're going to live there. And in exchange for them living in my property, every single month, they're going to send me a $1,000 check, because that is their rent payment. And now out of this $1,000, I'm going to use this to pay my taxes, my insurance, my maintenance, my management fees, my vacancy costs. And then if I have any debt on the property, it's also going to pay some debt. And if I do this the right way, I'm going to have some money left over every single month. And these profits go into my pocket for my investment. The thing that really differentiates real estate investing like this and investing in stocks like I talked about before is when I invest my money in real estate, I am looking for passive income. I am looking for cash flow. The most important thing here is not how much I think this property is going to be worth in 5 years or 10 years. In the stock market, that's what a lot of people are looking for. They're looking for companies that are going to be worth a whole lot more. That way they can sell their stock for a big profit. Here, I'm not really interested in that. The most important thing here is this cash flow. How much money do I gotta invest today, and how much money am I gonna make every single month? So it's a different investment strategy, because here, my goal is that passive income, it's that cash flow, and my investment goal is on a low end 7%, but typically I'm looking for an 8% annual return on my money. So if I invest $100 today, I want to get $8 back next year and the year after that, and on and on and on. So these are the type of returns that I'm looking for when I invest my money in real estate, and this is in the form of passive income or cash flow. The thing that makes real estate a little bit more difficult is in the beginning, while this is called passive income, it's really not passive, especially in the beginning, because you got to jump over this hurdle to understand how real estate investing works, and you got to find the team. I mean, you got to find your real estate agents, your property managers, your contractors, you got to work with city officials, and so if you don't know how any of that works, it's going to be a big time commitment, and you need a lot of capital. Like this property might cost you $100,000, so you're going to need either a lot of cash, you're going to go out to the bank and you got to borrow some money, versus if you're investing your money in the stock market, you can start with $100 and it only takes like 5 minutes. Here, buying a property can take you months. You have this element of non-passiveness because you got to find the deals, you're going to renovate them, you got to get them leased out. But once you get the hang of things, and once you get this property ready to go, you can hand over the keys to a property management company, and then it can be fully passive if you know how to do it. And so it takes that hurdle to jump over, but once you jump over that, then it can be completely passive. Now again, the key here to succeed over the long term is to keep compounding your money. That means when you have this money growing in this real estate property, you got this passive income coming in, you can do a couple things with it. You can use this money to go out and go on a nice vacation, or you can reinvest this money to go out and buy a new property. So that means over the years, you're going to save up some more cash to buy another property, and then you're going to use this cash to buy you more properties as well. So this cash should help you, fuel you to buy more properties quicker. That way you can increase the amount of cash flow and passive income you have. So it's kind of this compound interest game, where it's how fast can you accumulate these properties and how fast can you grow this passive income. But now, once you understand all the things that I talked about, first you got to understand the mental game, where you got to stop living in your feelings and you got to stop spending all your money. And then you got to work on how to grow the pie. How can you attract more money that we have more money to invest? Then it's all about investing your money, and you got to know your goals. Now you got to invest your money into places where you're going to grow your money. And now it's just a math question. Where can you invest your money? What type of returns can you expect? And how long is it going to take you to hit that $1 million based off of how much money you're investing? Once you understand the whole system, then it's just a numbers game where you got to just keep following the system, and you got to just keep pumping your money into your investments. That way you can build this nest egg that's growing to make you wealthier.
Most people should not be starting a business, and most people should not be operating businesses. They don't have it in them to run or operate or start a business. But what everybody can do is